Good morning. Today's my topic is tools of technical analysis. In the previous class, I have explained about the assumptions of technical analysis and other concepts related to technical analysis. So today I am going to explain about the different tools of technical analysis or the different theories of technical analysis which will help an investor to find out the movement of a price in the stock market, or which will help an investor to study the behavior of prices in a stock market. So that is about the tools of technical analysis. In another way, the theories of technical analysis which will help an investor to study the movement of or the behavior of prices of a security in a stock market, or to study the trend of a security in the stock market. So that is about the tools of technical analysis. So there are mainly four tools as per your concept. There are more number of tools which are available in the investment avenue or in the stock market, but as per the syllabus or as per the concept, you have only limited theories to study. Mainly the Dow theory, the bar and line chart, point and figure chart, and moving averages and relative strength analysis or relative strength line. So let me explain one by one. The first one, the Dow theory. It was introduced by Charles Dow and in the year 1851 to 1952, 1902, and this Dow noticed that the prices on market follow both long-term and short-term trends. It noticed that the Dow, the person who introduced that particular Dow theory, he noticed that the prices on markets follow both long-term and short-term trends. So whenever there is a movement in case of the price of a security in a stock market, that move by considering long-term as well as short-term trends, means by considering long-term factors as well as short-term factors. The short-term trend are reactionary and won't necessarily derail long-term trend. That means short-term trend in the stock market, these concepts are easy to understand once if you have some knowledge about the stock market, about the movement of prices of the security. If you don't have any knowledge, or even if you don't know about the chart, then it is difficult to understand the concept. He says the short-term trends are reactionary and won't necessarily derail long-term trend. So it says that the short-term trends are reactionary and it is not dependent on the long-term trend, or long-term trend are not necessarily dependent on the short-term trend because they are the reaction. Means in the short term in the stock market there will be high fluctuation, or we call it as a volatile in the stock market, and it won't influence generally on the long-term trend. Then the definition of Dow theory, a series of rules about market trends and how they are set and reversed. The theory is based on the teaching of Charles Dow, one of the two founders of Dow Jones Company. So it is the assumption, or you can say that it is just a strategies which you can apply in case of the stock market to study the behavior of prices of the stock market, but it does not provide to guarantee that it is 100% you will get the return, or 100% it will get the success, but probability of getting the return or getting the success by applying the Dow theory is the highest. So that's why most of the investors or institutional investors, they follow the Dow theory concept. So as per the Dow theory, there are 6 tenets which are applicable in the stock market, or which are founded in the behavior of the prices of the security in the stock markets. The 6 tenets of the Dow theory. First one, the three movements. He says that as per Dow theory, he says that there are three movements in the stock market, or three movements in case of the behavior of the investor, or sorry, behavior of the price of a security in the stock market, mainly primary movement, then secondary movement, and the minor trend. So in this way, the stock market or the price moves in the stock market. So mainly there are three movements in the stock market. Then what is primary movement? The primary movement means the movement which takes place within, we can say that it is a main movement which stands for long term, means for a long term period. Whenever that movement occurs, then it is called as a primary movements within, it will continue for a long term period, so that's called as a primary movement. And another is a secondary movement, which is for a short term duration, generally from 10 days to 3 months. That is called as a short term duration. The movement, the behavior is for short term period, and then it is called as the secondary movement, upward or downward. In case of the movement of the security is for 10 to 3 months, if it is that, then it is considered the secondary movement. Whereas in case of a minor trend, or it is a, it minor trend means of whenever the behavior stands for a particular hours, for a particular minute, you can say that. Mainly, in another way, you can say that the behavior of the prices in a particular day is called as a minor trend. So these are the three movements in the stock market. Primary movement, the movement of a security for a long term period, is called as a primary movement. If there is uptrend and if it is for stands for long year, then it is called as a primary movement. The secondary movement, the movement of prices up and down. In case of movement of the prices of the security from 10 to 3 months, generally in case of the derivatives market, it's called as a secondary movement. And another one is a minor trend, that day fluctuation or day volatility or day trend in the stock market is called as a minor trend. So these are the three movements as per Dow theory. Yes, of course it is there in the stock market, you can identify. Once if you get the knowledge about the stock market, then you can observe these movements in the stock market. And next one, another assumption or another tenets of the Dow theory is three phases of the stock market, or three phases of market trends: accumulation phase, public participation phase, and distribution phase. Namely, three stages: accumulation, public participation, and distribution stage. So these are tenets given by the our tenets as per the Dow theory, and which has been observed in the stock market. Then what is a public or accumulation means? What is accumulation? A small group of investors, they start accumulating the shares of a particular company that are likely to reach higher levels. But the price does not change at this stage, and as only a few investors start accumulating the shares directly. It says only one small group of investors, they continuously buy the securities of a particular company and they accumulate it, and they expect that it is likely to reach higher level in the future. And in at that time, whenever they buy the securities at the buying stage, there will not be any much movements in case of the prices of the securities, and only it will be with the only some small group of investors. So that is called as a accumulation phase. Again, you can understand this concept if you know about the stock market. These are purely applicable for the stock market. That's a accumulation phase, means buying the security and holding it up, but a particular group of investors continuously they will buy and accumulate it, and they means in the future they are likely to reach higher level. So that's the purpose of accumulating it. Next is the public participation, another phase. So slowly that information becomes public knowledge, means whenever some small group of investors, whenever they buy the securities of a particular company and they accumulate it, and that will become the information in the stock market. Slowly it will, later it will disclose it to the public as a information to the public, or you can say that later it comes to know the public, and everyone starts the buying of the shares of that particular company, and that is At that time, the speculative activities occur and suddenly the price of the security will goes up. So that is called as a public participation phase. In the first phase, a group of investors, they buy the securities continuously and they will accumulate it and they won't sell it. In later, the other investors, they comes to know that yes, there are some group of investors those who purchased the securities and who hold it or accumulated it, and suddenly other peoples also, they will, other investors also, they will buy the securities of the same company. So at that time the demand will increase, the price will goes up. The investor or a group of investors who purchased the securities in the first stage, now they will try to sell, but they won't sell it. Here in the public participation, the price of the securities will goes up because of the speculation activities. In the first stage, the price of the securities will not goes up, but in the second stage, price of the security will increase rapidly because of the speculation activities or because of a high demand from other investors, either individual investors or from group of investors. Then in the third stage, that is the distribution stage, in that stage the original buyers, those who borrowed the securities in the first stage, in the accumulation stage, the original buyers in the first stage, they start to sell the securities, taking a little stream out of the prices of the shares. So they will now distribute the security. Now they will come out, they will, whatever the securities accumulated in the first stage, now they are going to sell it because price reached to higher level. So that is called as a distribution stage. So these are all the speculative activities in the stock market. So that's another tenets, three phases of the stock market. Next one is factoring all the news. Factoring all the news means the market consider each and every news or every factors of the stock market. So that's considered as a factoring all the news, means behavior moves after considering all the factors. If there is uptrend in the price of the security, then it is because of some influence of some factors. If there is a downtrend in the price of or behavior of the stock, then it is due to some influential factors. So means of all the factors will influence on the behavior of a particular security. Next is a synchronized averages of related variables. See, all the averages of related variables should move in the same direction. All the related variables must vary so as to form a symphony. If the industrial activities is being observed, an increased average must be accompanied by higher index collections by the government, or a higher power consumption, or a high transportation activity, and higher income generation by the finance market. So this means average of all the related variables to that particular security will be synchronized, and means that will be taken into consideration. Next, volume should confirm the trend. It means the volume should confirm the trend, means a bull market should be witnessing higher values of buying the shares. Similarly, a bear market must witness a large scale sales. Where the needed volumes are absent, it may not lead to a trend. Means if there is a higher buy bull bull or a high buyers or purchase in the stock market, then it is called as a bull trend. Whereas the high sales in the stock market, then it is called as a bear market or bad trend. If there is no purchase and sale of higher values, then it is considered a consolidation in the market. So that is about the volume should confirm the trend. Next is the trend continues. The trend in the stock market will continue for a long time, irrespective of the difference of opinions about the near future movements. For some days, the movements may be opposite to the trend, like a decline in prices in bull trend or increasing prices in a bad trend. But after a couple of days, the market will come back to its original trend. Only when the factors indicating the reversal of the trend manifest themselves, we cannot believe that the trend is petering out. So these all is called as a trend continuous. So that is a trend exists until definite signals proves that they have ended. So that's about the six tenets of Dow theory, and which has been given after observing the trends in the stock market. So one of the technical analysis or a tool of technical analysis about the Dow theory, which I explained. Now the second tool or theories of technical analysis, bar and line charts, which will again helps an investor to take the decision of investment. Bar chart, bar and line chart, there are two charts. One is a bar chart and another is a line chart. Bar chart consists of multiple price bars with each bar illustrating how the price of an asset or security moved over a specified time period. Each bar typically shows open, high or low or closing OHLC prices of a security. Although this may be adjusted to show only the high, low or close prices of a security in the stock market. So bar through the bar chart you can study that open price, higher price, closing price and lower price of the securities. So that is a help, that is a how the bar chart help to investor. The technical analyst use bar chart or other chart types such as candlestick or line chart to monitor price action, which aids in trading decision, which helps in trading decisions. Bar charts allow traders to analyze the trend, spot potential trend reversal, and monitor volatility and price movements, to monitor the volatility and price movements of a security. A bar chart visually depicts the open, high, low and close price of an asset or of a security in the stock market in a particular period. The vertical line on a price bar represents the high and low prices of the particular day. The left and right original horizontal lines on each price bar represent the open and closing prices. So that is a that's another category of bar chart. That is the left hand side and right hand side open price and closing price, which is not there in this particular diagram. The bar charts can be colored coded. If the close is above the open, it may be colored black or green, and if the close is below the open, the bar may be colored red. Again, it is not there in this diagram. This is one type of bar chart. There are a lot of types in case of bar chart. So ultimately, bar chart will help an investor to study about the movement of the securities in a stock market. So this is again another theory. With this also you can take the decision of investment. The next is a line chart. A line chart is a graphical representation of an asset's historical price action that connects a series of data points with a continuous line. So you can see the diagram here, or the picture of the line chart. So this movement of the price of the security, ups and down, ups and downs, ups and downs. So it connects each point. So that is called as a line chart. This is the most basic type of chart used in finance, and it typically only depicts a security's closing price over time. So generally it shows the closing price of a particular security in a particular time. Line charts can be used for many time frame, but they most often make use of day-to-day price changes. So most of the time it is applicable to day-to-day price changes. A line chart is a type of chart that displays information as a series of data points. Means here there are data points connected each one by straight line segments. A line chart is a way of visually representing an asset's price history using a single and continuous line. So that shows the price history of a particular security. And it is easy to understand and simple in form, typically only depicting only changes in an asset's closing price over time. So it is only the generally it shows the closing price of the securities in a particular specified time, because mainly the line charts usually only shows closing prices. They reduce the noise from less critical times in the trading day, such as open, high and low prices. These are most complicated ones. So therefore it shows only the closing prices of the securities in a particular specified time in a particular day. Even it is there for the month or for for a particular year. Because of the simplicity of line charts, the traders looking to identify patterns or trends may opt for charts types with more information, such as a candlestick. See, candlestick is another technique or tools to study of movement or behavior of security in the stock market. So that's about a line chart. The next one is the point and figure chart. Is the third tool of technical analysis, point and figure chart. The design it designed for long-term investment. Point and figure charts have been described as one of the simplest system for determining solid entry and exit point in the stock market trading for long term. This charting system monitors supply and demand of each issue while keeping an eye on developing trends. So it mainly dependent on supply and demand for a particular security. What makes point and figure chart unique is that they do not account for the discrete passage of time as most of other types of chart do along their x-axis. So there is no discrete passage of time in case of means there is no timing in case of a point and figure chart, when other charts there shows the point or timing through the x-axis. While point and figure charting has never been at the top of the list of the popular techniques used by the technical analysis, there is a growing interest in point and figure chart from all corners of a charting community. Most of the time it is not most popular techniques in case of stock market, but there are some group of community who follow the point and figure chart. Here we take a close look at point and figure chart, and you can how to read and construct them. So that is it stands typical when compared to the other charts. See, bar chart you can easily understand increase and decrease, and through the line chart also you can easily understand the movement of the security, but here it is difficult to understand. See, in case of point and figure chart, it utilizes columns consist of stacked X or O's, each which represent a set of amount of price movements. X illustrate rise in prices. See, X says it is a rise in price, whereas Y, O says represent fall in price. So if you know that, then only you can understand it. The line chart, you can easily say that yes, there is uptrend. Yes, it is up. If a line goes upward, and you say it is uptrend. Line goes downward, then you can say that it is a downtrend. But here X represent what? X represent rising prices of security. Y, O represent the fall in case of price of the security. So that is about a point and figure chart. So there are a lot of tools, and you can apply any tools if you are interested in case of trade in the stock market. Mainly it is applicable to trading in the stock market for the either for the equity or for the derivatives market, means for day trading or for the optional trading or even for the long term investment. This will help an investor, but there is no guarantee. So the probability is high. You can in some technical analysis will probability say you get 60% success, 70% success or 80% success. Some says only 50% success in the stock market, but there is no guarantee. So thank you very much.